Click the bell icon to get latest videos from Ekeeda.
Hello friends, company issues shares to raise capital. Company issues shares to public to raise funds, that is capital. Sometimes company issues shares without receiving cash, that is for a consideration other than cash. Let us understand this concept in this question. Let us read question. Games and Company Limited acquired the running business of Mr. Gunthe. The business consisted of assets of 50 lakhs and liabilities of 8,20,000. Equity shares of rupees 100 each, fully paid, were issued to the vendors in payment of purchase consideration. Past journal entries in the books of Games and Company when shares are issued at par, shares are issued at discount of 5%, shares are issued at premium of 10%. Shares issued at par means issued at the rate of 100. Issued at discount of 5% means rupees 5 less, that is at the rate of 95. Issued at premium of 10% means issued at the rate of 110. Games and Company acquired running business of Gunthe. The business consisted of assets rupees 50 lakhs and liabilities rupees 8,20,000. Assets taken over 50 lakhs, liabilities taken over 8,20,000. So the net asset value of business taken over is 41,80,000. Here the amount of PC will be based on net asset, that is purchase consideration. Games and Company will require to pay Mr. Gunthe 41,80,000, that is net asset taken over. This will be amount of purchase consideration. Here while making payment, company is issuing shares to him instead of cash. Therefore it is said that issue of shares for a consideration other than cash. We are not receiving cash from Mr. Gunthe, but we have received net assets worth 41,80,000. Therefore, we are required to issue him shares to settle purchase consideration. Assets account debit 50 lakhs, to liabilities 8,20,000, to Mr. Gunthe's account 41,80,000, being business purchase recorded. We are required to settle this amount of 41,80,000. That is the amount of purchase consideration, that is price for the business purchased. Here three options are given. If shares are issued at par, that is equity share of rupees 100 each, fully paid, then what will be the journal entry? Mr. Gunthe's account debit 41,80,000 to equity share capital account 41,80,000. Number of shares issued we can calculate. PC amount is 41,80,000 divided by 100, because shares are issued at par. So 41,800 shares are issued at the rate of 100 each, fully paid to settle amount of purchase consideration. Being 41,800 equity shares issued of rupees 100 each, fully paid for settlement of purchase consideration. Shares are issued at a discount of 5%. This is the second alternative question. If shares are issued at the rate of 95, then what will be the situation? When shares are issued at discount of 5%, nominal value of share is 100, so they are issued at 95. 41,80,000 is purchase consideration. 41,80,000 divided by 95, it comes to 44,000 shares. That means 44,000 shares of rupees 10 each, fully paid, are issued at 5% discount. Mr. Gunte's account debit 41,80,000. Discount on shares account debit 44,000 shares, per share discount 5 rupees, 2,20,000. To equity share capital account, 44,000 shares multiplied by 100, 44 lakhs. Being 44,000 equity shares issued at 5% discount in settlement of purchase consideration. When shares are issued at a premium of 10%, that is at the rate of 110, shares are issued at a premium of 10%. Here share of rupees 100 will be issued at 110. Total amount payable is 41,80,000 divided by 110, it comes to 38,000 shares. Mr. Gunte's account debit 41,80,000 to equity share capital account on 38,000 shares 100 rupees, 38 lakhs. To securities premium account 38,000 multiplied by 10, 3,80,000. Being 38,000 equity shares of rupees 100 each issued at 110 in settlement of purchase consideration. In this question, we have understood that shares can be also issued without getting cash, that is for a consideration other than cash. In this question, shares are issued to purchase business. Shares may be issued at par, issued at premium, or even at discount in such situations. Thanks for watching this video. Stay tuned with Ekeeda and subscribe to our channel Ekeeda. Thank you.